All right, thank you all for being with us today. Can everybody on the line hear me? If so, why don't you go ahead and type yes in the comments just to make sure we're good to go. All right, before we get started, I want to introduce you to everyone that's on the webinar with us today. So with us is Caleb Bining, who is a business development manager for STRATAFOLIO, and Jason Rogers, who is an associate broker with Pivot Real Estate out of Cedar Rapids, Iowa. My name is Jerry Frank, and I'm the CEO and co-founder of STRATAFOLIO. STRATAFOLIO is a cloud-based software solution that provides financial analytics to people who own, manage, and lease commercial real estate so that companies can easily access their financial data to share it with their lenders or investors or for even their own use. Throughout today and the webinar, please feel free to write down questions, put it in the chat session, and at the end, we will address your questions, and if we are not able to get to all of your questions, we will email you afterwards with our answers. Okay, let's take it away, Caleb.
Thank you. So today we'll be talking about several topics revolving around the cap rates. First, the importance of the cap rate. What is the advantage of your cap rate over other performance metrics? Second, common struggles that we see. What difficulties do we see most investors suffer from on a daily basis? Third, solutions you can use to combat these issues. And finally, actionable steps that you can implement today. First, we'll do a quick run through of what a cap rate is. A cap rate can be defined by Investopedia as the most popular measure through which real estate investments are assessed for their profitability and return potential. The cap rate simply represents the yield of a property over a one-year time horizon, assuming the property is purchased on cash and not a loan. The cap rate simply indicates the property's intrinsic, natural, and unleveraged rate of return. The capitalization rate is most commonly termed cap rate, and it's how we'll be addressing it throughout this webinar. The cap rate is found by dividing the net operating income by the purchase price. In more depth, the net operating income represents the operating expenses, operating income minus the operating expenses. You can think of it as gross profit before debt servicing. This normally comes out as a single-digit percentage. However, it's common amongst the industry to simply call them caps. For example, an 8% capitalization rate can simply be called an 8 cap. This formula can be algebraically shifted to find any desired factor relating to the cap rate. We can think of cap rate as the speedometer to your real estate portfolio. As you begin a long road trip, you have a starting point, vehicle, and endpoint in mind. You begin your real estate journey similarly. As you drive the car, there are many things to focus on. For example, speed, miles per gallon, up-and-coming road marks, and etc. Yes, you could go through and you could calculate these all manually. However, using a speedometer makes it easier and more accurate. This allows you to keep your eyes on the road instead of being distracted by these calculations. Your real estate portfolio can be seen as the same. Instead of focusing on daily calculations, let the software do the work for you so that you can keep your eyes on the road and get to where you need to be safely. Cap rate is a unique measure that we use in commercial real estate to read long-term financial performance. The cap rate is found again by taking the NOI, which is the operating income, minus operating expenses divided by the acquisition price. It can be used by buyers, sellers, and lenders to price deals. However, one of the most powerful utilizations of the cap rate is to determine an appropriate market price. Since cap rate and market price are directly related, having a firm understanding of your cap rate and cap rate expectations can help you force appreciate your assets. Let's take a break and do a quick term recap. First, cap rate. NOI divided by purchase price. Second, the NOI. This stands for net operating income, which is your operating income, minus operating expenses. You can think of it as rental gross profit, excluding debt servicing expenses. Third, operating income. This is all income collected from operating the building. This includes everything from rent to parking fees and even laundry income. Next, operating expenses. These are all associated expenses apart from debt servicing. You can think of utilities, snow removal, and even management expenses. Now let's hypothesize that we're buying an apartment building in Madison, Wisconsin. We buy our building for $1 million at an 8 cap. So our NOI is $80,000 a year. We found this by taking $1 million times 8% to find that $80,000 a year NOI. While operating this building and keeping track of our metrics from a bird's eye view using STRATAFOLIO, we notice small rooms for improvement. We notice areas where we can not only increase our operating income, but decrease our operating expenses. Say we're able to go through and increase this NOI by $15,000 a year. We have now increased our NOI to $95,000 a year through either, again, increasing our operating income or lowering our operating expenses. When we take 95,000 divided by 1 million, we find that our new cap rate is 9.5%. After sharing this good news with our lender, they suggest that we either go through and sell or refinance the property for a profit. Through this crisp operating, we're now able to leverage our cap rate for a realized gain. Since buyers are willing to buy at an 8 cap, we're able to raise our selling price until our 9.5 cap goes back to an 8 cap for resale. This makes our new market price $1,187,500. Not only did we force appreciate by $187,000 from simply tracking and operating our asset in an organized and efficient manner, but we now have a couple options to secure this gain. We can either hold on to our new strongly performing asset, sell, or talk to a lender about a refinance. The use of software can also add value when financing, ultimately making lenders and investors feel more comfortable. There's increased lender comfort, which allows for better terms in case of LTV, amortization, and even deal structure, transparency and comfort for the investor, and it helps buyers and brokers make more informed decisions, leading you to better resale. It increases the buyer's likelihood to secure financing. Many lenders have told us that the use of software such as STRATAFOLIO would give them more confidence to lend the funds for an acquisition because the clarity reduces the risk of surprises. This also brings you lower expenses. Because these are easy to track metrics through the software, it provides the clarity to compare and track expenses and match them to their appropriate levels. Because the cap rate is a uniform measure of performance amongst investment properties, it can most efficiently be used to compare income performance. With the cap rate being tied to income and price, a cap rate can be an investor's guide towards properties with a stronger rental rate of return and lower expenses. It can also be used to find opportunity to increase the NOI. As we talked about before, it can not only be used as a tool to increase the market value of your property, but it can also be used to make long hold investments more profitable by finding opportunities for improvement when comparing to others in the market. This means that it can also be used for a determinant of appropriate market price. For example, if your particular area averages sales at an 8 cap, you can use this as a compass to determine what an appropriate sales price for your property would be. This can be used as a tool for negotiation if the cap rate is too low, and also a tool for negotiating a higher sales price if your cap rate is above average. Now that we've learned the importance of a cap rate from a developer, manager, and lender's perspective, let's hear from our experienced broker, Jason Rogers.
Hey, Caleb, thank you very much. My name is Jason Rogers. I'm with Pivot Real Estate in Cedar Rapids, Iowa. The cap rate is a great benchmark for an analysis tool. And it's important no matter if you're a single family homeowner or a $1 billion private equity firm. The cap rate does not include some important things, obviously property appreciation, principal pay down, tax shelter, as well as IRS tax shelter, as well as some other variables. So the cap rate is an arbitrary rate established by some experienced appraisers and brokers in your marketplace. I do want to talk through a few, I'll say, issues or cons or some things you should be aware of as an investor. One, the cap rate really is only an analysis on a 1-year time frame. I think that's important to note. And it's not a full effective rate of return. Obviously, it doesn't account for the things I mentioned, appreciation, principal pay down, tax shelter, but it also doesn't account for things like you're using a cap rate based on purchasing with all cash. So it doesn't account for that loan. Higher cap rates oftentimes can lead to headache factors, high headache factors, as well as obviously a lot of risk. Again, cap rate, it's a quick and easy tool. It's a great benchmark. How to establish a cap rate is it's important. Some other factors, you got to consider the age of the property, the location of the property from a micro and a macro perspective. The condition of the property is also very important. The type of the property or the flavor of the property. Is it multifamily? Is it warehouse? Is it industrial? Is it retail? And what impact do those types of properties have in the current economic environment? Again, with commercial properties, is it a property with a credit tenant, or a tenant that may be on a term lease that likely could not renew? So these are all variables you need to consider when analyzing your property that the cap rate really doesn't fully show you. Also, keep in mind regional factors as well as more macro factors, as far as certain marketplaces like Nashville, Austin, Denver are all requiring 10-year lease terms and pretty high rates. Those are hot markets right now. Therefore, your capitalization rate could be quite low, and the market potentially might not be a great place for investment, or you can bank on that it's going to continue to grow. So that's all I have, and I'm going to turn it back over to Caleb.
Thank you very much, Jason. So how can we help with all of this? STRATAFOLIO helps you manage the chaos of trying to keep track of your portfolio's performance, vacancies, and debt servicing all in one easy-to-use interface. This helps you navigate through your data and keep your eyes focused on the road for your long-term portfolio goals. STRATAFOLIO acts as the speedometer to navigate these roads by helping you harness the power of your data and make stronger decisions. When talking to other real estate investors like you, we realized how many moving parts have to be kept under control in order to run a successful portfolio. The common struggles that we saw many real estate investors and managers deal with on a daily basis included, but were not limited to, competition, market conditions, leasing, maintenance, financing, and even tenant relations. STRATAFOLIO provides investors, owners, and managers the power to harness your data and make stronger decisions because of our unique attributes. Unlike other financial management software, STRATAFOLIO is real estate specific. This allows you to see your portfolio from a bird's eye view rather than be at constant strain of daily management, which in turn allows you to focus on your long-term growth. As you can see, STRATAFOLIO's real estate specific interface gives you the tools you need to run a successful operation. STRATAFOLIO helps provide you with less headache, focus, professionalism, better financing odds, resale odds, investor transparency, organized records, and even better in-house understanding. Thank you, and now we'll move on to questions.
Okay, I think we did have a couple of questions already. So one of the first things we were asked is, how do I know which cap rate to use when analyzing an investment? You want to take that one, Jason?
Sure. So again, a good question. You can contact your local appraiser or local commercial real estate broker. Keep in mind, you don't want to ask, hey, what cap rate should I use? They might hang up the phone on you. You need to have the details of the property that you are looking to invest in. Describe to them, what's the condition, what's the tenant mix, is it commercial, is it multifamily, what type of property it is. Give them as much detail as possible, and probably even the address, and they can probably give you, a cap rate or even a cap rate range for you to use in analyzing your investment. And the other important question to ask yourself is, what is your desired rate of return? That's also a tool to implement within analyzing using the cap rate.
And how do you establish what is that cap rate that I should be focusing on?
Another good question. Well, I mean, again, like I mentioned before, the higher the cap rate is oftentimes the higher the headache factor, and the lower the cap rate is kind of easy. You're going to see, your typical Walgreens with a 15 to 20 year lease at a 5 to 6 cap, maybe a 7 cap. Obviously, that's an easy easier return. Some older, dated, maybe they're multifamily properties and poor locations, you might see those at 12 to 15% cap rates. Well, that's because they're going to be pretty management intensive, and you're going to have those headaches and have to deal with that, even if you aren't the day-to-day property manager.
Are there other questions that you frequently get asked as a broker that around cap rates?
Yeah, I mean, the main one is this the best tool to use? And I would answer that vaguely as it's a good benchmark to use. It's a good starting point. It's good to start your analysis with a cap rate, and then you can utilize cash on cash and ROI to determine if it's a good investment.
Okay. Other questions that we're getting is, what do I need to qualify to use STRATAFOLIO? And actually just reach out to us. You can reach out to jerry@stratafolio.com. If we don't have any other questions, I think we will call it a wrap. Thank you everyone for joining.